Welcome back to my YouTube channel, and in today's video, I'm going to be showing you a simple trading strategy that works with a high win rate on all time frame and asset classes. This strategy is known as the breakout strategy. I'm sure you have heard of several breakout strategies, but today I'll be explaining a unique approach to trading this strategy with the entry, exit, and trade management criteria, as well as certain precautions to help you avoid the unnecessary losses that a lot of beginner traders experience. I will also go through a brief case study that I took using this strategy, just so that you fully understand how it works and how to implement it into your trading plan. So let's dive right into it. Let's start with understanding what is a breakout. A breakout occurs when the price of an asset breaks beyond a key support or resistance level. This usually leads to huge price movements. Breakouts also occur when the price breaks out of a consolidation range. In the example here, we can see that price is moving in between a range. This shows that both buyers and sellers are present, but the buying and selling pressure are not strong enough to push the price out of the range. The top of the range is the resistance, while the bottom of the range is the support. Now, a resistance is a price ceiling that buyers have consistently failed to break above. Conversely, a support is a price floor that sellers have consistently failed to break below. To confirm the formation of support and resistance, you have to wait for the market to break above the resistance or break below the support level. Once the market breaks out, that provides a good buy or sell entry. Now that you understand what breakouts are, let's discuss how to find these breakout setups. First things first, to find high probability breakout setups, you need to understand breakout patterns. Breakout patterns are essentially patterns that the market creates while consolidating. There are several patterns formed from horizontal and diagonal support and resistance levels. Now, if you spot a downward trend line and a support line, this is a triangle pattern. If you spot a support and resistance level, then it's a rectangular pattern. If you spot two opposite trend lines, it's a pennant. If you see two trend lines that are heading in the same direction, then it's a flag pattern. Now, here's an important point to note. A lot of traders make the mistake of trying to find these exact patterns all the time. The problem with this is that it's unrealistic and unproductive to trading. Instead of focusing on the patterns, try to focus on finding the key levels. So what are these key levels and how can you find them? Well, key levels are horizontal and diagonal support and resistance levels. The presence of key levels on opposite sides keeps price in a range. Breakout occurs when price breaks out of the key level on either side of the price range. The name of the pattern doesn't matter. You simply need to understand three things. Number one, price consolidates. Number two, it forms key levels. And number three, price breaks out of the range. After identifying the presence of key levels in the price range, the next step is to identify the direction of the breakout. This is important because the financial market is highly manipulated, and consequently, a lot of traders fall for false breakouts. False breakouts occur when the candle trades above or below a key level, just to entice traders to take trades in the wrong direction. This does entice a lot of inexperienced traders and leads to losses. Now, here's two ways to avoid it. Firstly, you need to examine the breakout candle itself. False breakouts are often categorized by candles with low volume and momentum. Ideal breakouts have larger candles. This shows the strength and explosiveness of the new trend and makes it more likely for the trend to continue. It could be one large candle or multiple medium-sized candles. The second method of confirming a breakout is to wait and observe the momentum of subsequent candles. After a breakout, the new trend usually leads to an expansion, meaning that you are most likely going to see a series of bullish or bearish candles as the case may be. If the next candle closes in the direction of the breakout, this confirms the strength of the new trend. Whenever the market breaks out of a key level, there are three possible scenarios. Number 1, a continuation of the new trend. Number 2, a retracement followed by a continuation of the new trend. And lastly, number 3, a reversal, or otherwise known as a false breakout. Now, it's important to know these three scenarios because they will guide most of the trading decisions you will make when you are trading breakouts. Now that you understand breakouts and how to trade them, let's discuss the entry criteria, exit and trade management criteria, and a case study of a breakout trade that I took recently. So let's look at the entry criteria right over here. After a breakout, the market might retrace before continuing the new trend or simply continue the trend with little to no retracement. This provides you with two entry styles or opportunities. Number 1, you can enter at the close of the breakout candle, or number 2, you can enter upon a retracement or retest of the key level. I understand that as traders, we are all built differently and so we have different unique trading styles. But personally, I prefer to enter upon the breakout candle, because in some cases, the successful breakout leads to expansion or a strong market trend that has no retracement. So if you enter at the open of the breakout candle, it helps avoid missing these trades. Personally, I'm more comfortable using a wider stop loss than missing out on a profitable trade. Now, it might be different for you, so decide what's best for you. Before entering the trade, remember that the momentum of the breakout candle and subsequent candles are extremely important. I prefer to enter on large volume breakouts that close beyond the key level. My stop loss is usually placed just above or below the key level. This is a reasonable stop placement because it's compatible with two different market scenarios. This means that if the market retraces after the breakout, then your trade remains protected. But if the market continues in the new direction, then your trade remains in profit. So let's move on to exit and trade management. Breakout scenarios tend to have large expansion. This is because of the increase in the number of buyers or sellers after the breakout occurs. The momentum of the breakout is usually sustained as price expands. So this makes breakout trades extremely profitable with good risk to reward ratios. Therefore, I tend to target at least a 1:3 risk to reward ratio on my breakout trades. The trade management strategy that I use can be divided into two types. The first is the partial profit system. Taking partial profits simply means closing a certain percentage of your position when the market moves in your favor. For instance, if you open a buy trade with one lot, then you can close a certain percentage, say 0.5 lots, once the market trades in your favor. After taking partial profits, you can move your stop loss to break even to protect your capital and make the trade risk-free. This risk management strategy has two advantages. Firstly, it rewards your effort by closing off some profits. This helps to soothe the mental strain of holding positions for long periods, since you have already rewarded yourself. Number 2, it ensures that you are able to capitalize on major market moves and expansions by leaving an open position running. So let's move on to the second trade management strategy that involves the use of an indicator called the chandelier stop. I've covered this indicator on this channel before. So what I will do is I will link to that video at the top right corner and leave the video down in the description below. So check that out if you need more information on how to use this indicator. But this indicator can be easily accessed on TradingView, and you have to go to settings and change the ATR multiplier value to 2. Now when price moves in your direction, move your stop loss to break even. You let your remaining positions run until price closes below the chandelier stop. Once this happens, then you close your remaining positions and take profit. The advantage of using this method is that by doing this, you will be able to profit as the market moves in your direction because half of your position would still be open. Using this method of trade management helps to maximize the profit potential of your trades. So let's take a look at a buy trade that I took on CAD franc using this strategy. CAD franc has been in an uptrend on the daily time frame thanks to rising oil prices that caused the Canadian dollar to strengthen. Before taking a buy trade, I waited for the market to create key levels of diagonal support and resistance. These key levels formed when the market consolidated. As you can see on the charts, there was a false breakout to entice inexperienced traders to take buy positions. And fortunately, I was able to avoid this trap by waiting for a solid break above the key level. The breakout occurred with a momentum candle with a bullish close. This confirmed the presence of buyers and I took a buy trade at the close of the breakout candle. The stop loss was placed just below the momentum candle and I exited this trade when price closed below the chandelier stop over here. This strategy is a simple and effective strategy and I hope you are able to implement this in your trading plan as well. If you like this video and would love to learn more about trading, then don't forget to like and subscribe to the channel. Thank you so much for listening and I'll catch you in the next one.